So in this class, I will be calculating 4 profitability ratios. The purpose and objective of calculating profitability ratios is to understand the profitability situation of your company. And that means if the company is making enough profit or not, if the company's profits are increasing or decreasing, what is causing that increase and decrease, and what could be done to improve the profitability in certain areas. So we will cover only 4 areas. There are more areas which could be covered. I am not going to discuss ratios here because I have done the discussion in my other videos which I posted in the recorded videos folder. So you should have watched those and you should know what these ratios are. My target is to calculate all of these 4 ratios in this class and then do a bit of explanation about the results. The main task for your coursework is to calculate ratios, and in calculating ratios, the main task is to locate and extract the figures which are needed by the ratios formulas. So for example, looking at return on capital employed, we can see that the formula is operating profit divided by share capital and reserves plus long-term loans times 100%. So 100% is just to convert the result into a percentage. It's not that significant. So the job here is that we locate all of these figures. So we need to know where these figures are. So that's what I will explain in this video, and then I will locate and extract those figures, and then I will use those figures to calculate the result. So let's find out first of all our operating profit, guys. Operating profit is a figure which is available in the income statement. So you will see now that before we have not looked into the financial statements. We just discussed them briefly. But while we are calculating ratios, they're actually making us go into the financial statements and look for each figures one by one. So we will understand each statements as well by doing these ratios. So first of all, guys, we need to locate operating profit. Operating profit will be given in the income statement, and income statement is available on page 69 of the money handbook. I made that. What I've done, I have crossed the first 2 columns. So the income statement in front of you guys, you can see that there are descriptions on the left hand side, then there are notes, and I will explain what that means. And then there are 6 columns, 3 for 2018 and 3 for 2017. Now I must remind you that you should pick a company which is not Marks and Spencer, and the annual reports should be 2020, 19, and 18, 3 years. You would pass if you only do 2 years, but you will not get more than 50 marks. You will just pass if you do everything right. And if you do only 2 years, you will still pass. But to get good marks, you need to do at least 3 years. So we don't need the first 2 columns for each year. We only look at 2018 total columns for both. So what we need, first of all, we need an operating profit figure. And as you can see that I have highlighted operating profit, and operating profit for 2018 is 156.5 million pounds. It's a positive figure. Positive figure is a good thing. And for 2017 is 253.2 million pounds. So that is one figure which we needed for our formula. So the next thing which we need to look at is share capital and reserves, and long-term borrowings or long-term loans. These are two figures are available in the balance sheet. So I'll go to my next page, which is balance sheet or statement of financial position. There are two columns, 18 and 17, and the thing, share capital and reserves is basically means total equity. Okay, you can see here the figure of share capital, and everything else here is called reserves. Okay, so the total is equity, and these are the figures which we need: 2954.2 and 3,150.4 million. Equity is normally very easy to locate. It's clearly given in statement of financial position. The problem is with the borrowings. The borrowings are, first thing is that borrowings, there are different wording, or loans are different wordings are used. So first of all, you have to read. So the first thing you need to go is to the non-current liabilities and look at all of these liabilities which are given in this area. Almost all of them are not actually liabilities. They are called provisions, which are like liabilities but not really a liability. Like, you don't really have to pay them, except the item for borrowings or loans. Okay, and in this case, Marks and Spencer calls loans as borrowings, and I have highlighted this figure. These are the figures which we should note down. We will use them in the formula. And another problem with the borrowings is that sometimes the borrowings are also given in the current liabilities as well. And the reason is, although for the Rocky, you should always use long-term loans or long-term borrowings. However, why we are picking figures from current liabilities? Because current liabilities are 12 months. They are not long, they're short. And the reason is that if you take a loan for 5 years, when you start paying it in the next 12 months, it will become a current. That part would become current. So you borrowed 5 million, and then you need to pay 1 million. So you borrowed 5 million for 5 years. So the first 1 million you need to pay after 12 months. That 1 million is a current liability, although you took it as a non-current liability. Basically, you don't use borrowings on the basis of name, but you use the borrowing on the basis of why they were taken. And the long-term borrowings are actually taken to be invested in the non-current assets. So even though some of that borrowing sits in the current liabilities, but because those borrowings were used to finance non-current assets, they should be used in return in Rocky. So I'll pick up the figure from the current liabilities as well, which is borrowings and other financial liabilities, and I'll pick these two figures up. And I will scroll this formula. So already written few things. I'm doing 2 years. You're gonna have to create a very similar table for your coursework. One more item maybe you can add here, and that is formula. Okay. Maybe give the formulas as well. I'm not doing it because I don't have time, and then I can't display everything. So I will remove it, but I would recommend that you do that. All right, so the formulas wants us to have operating profit, and it also wants us to have equity plus long-term loans, borrowings, whatever you want to call it. The operating profit we noted was 156.5, and the equity we noted was 2954.2, plus the long-term borrowing we noted were 1670.6, plus the long-term borrowings in the current liabilities are 125.6. So we got this, and we can put workings for 2017 too. So 253.2 divided by 3150.4 plus 1711.7 plus 518. And we can solve this now. 156.5 divided by, brackets open, 2954.5 plus 1670.6. It was an easy way of doing it, but I did it for the sake of comprehension. Next time I'll do the quick way. So if I press enter, it will give me the result 3.04. It was giving me a figure like this. 1 minute. A number. It was giving me a figure like this, but what I did, I converted it into a percentage, and now I have 3.04. Now for 2017, this figure divided by the values 3150.4 plus 1711.7 plus 518, brackets closed, and 4.71. Let me switch on the lights, guys. Okay, so we have calculated ROCE for Marks and Spencer for 2 years, and this shows that ROCE for M&S has declined or deteriorated in the last year or two, from 2017 to 2018, which is a bad thing. So that is understanding of the results. Okay, that means the profit has gone down, the performance in this area has deteriorated. You can also do a bit more analysis at this stage, and that is calculating an overall trend. And that could be done by taking the difference of the first year and the last year. In this case, there are only two, but if you have three, then you pick 2018 and 2020. So in this case, it's simple. I'll pick my base. Base is always the earliest year, 2018 in your case, minus 2018 divided by base 4.7%, press enter, and you get this really crazy number. And the reason for that is that we didn't use brackets. So let's put brackets there. And we have slightly less crazy number. But what we can do, if we reduce the decimal places, it will look less crazy number. And this shows that the ROCE has decreased by 35% over the year, which is quite a significant drop. What next to be done after doing this? Obviously, this is basic. The next thing you would do is pick up a competitor and calculate ROCE for that, and then make the comparison and see how your company is performing in comparison to a competitor or industry averages. So it it could be the case that Marks and Spencer Rocky has decreased by 35%, but maybe the competitor's Rocky has decreased by 50%. So that means Marks and Spencer is doing much better than its competitors. Or maybe competitors Rocky has decreased by only 10%, or maybe it decreased, it increased. So that means Marks and Spencer is doing far worse than its competitors. The last stage of analysis is to find the reason for this, and that needs quite a bit of research. For that, normally you will need to look at all of the numbers involved in the ratio, and then look at each figure to see which figure has impacted on the change in the result. So that is something which you need to figure out yourself. That was Rocky, guys. Next is our GP ratio. Gross profit ratio is gross profit divided by turnover. Both of these figures should be available in the income statement. This ratio is a lot simpler than Rocky because Rocky has 3 figures, and those figures are available in 2 different financial statements and not one, while GP ratio is simply available in one income statement. So remember the formula: gross profit divided by turnover times 100%, and this would help us to calculate this ratio. So what are these 2 figures? So let's go to income statement now, page 69. So that's our income statement. So we are looking for gross profit figure, and it should be here, but it's not here, and that is the problem. Sometimes companies don't give GP ratio, GP figure in the income statement. Sometimes they give it in the notes. So I explain that I will discuss these things later. I'm explaining them now. Sometimes the figures which are not here on the financial statements, they are given in the notes. And I think in this case, the GP is given in the notes. And for that, I'm going to have to look at note 2 and 3. So going to our note 2 and 3, page down, note 2. So I just saw note 2 here. This explains the revenues, how the revenues were generated, what were the different departments of Marks and Spencer, and so on. And note 3 actually gives a breakdown of our income statement. And here I can find the figure of gross profit. I will write it down, I will note it down to be used in the calculations. So that was one figure which I needed. The second figure was revenue, which is also, well, we already know that it's in the income statement, but we can use this figure too. So we got both the figures which we needed in our calculations. So now we can go back to our Excel. I'm looking for gross profit, and the second figure is revenues. So gross profit was 4047.3, and the revenue was 10698.2, and 4087.8 divided by 10622. One thing, guys, I didn't do here was multiplying by 100%. Okay. Same needs to be done in the workings multiplied by 100% and 2.2. So I'll do the same here, times 100% times 100%. Now I will solve it. 4047.3 divided by 7.83 and then 0.87.8 divided by 34.48. So we have calculated gross profit ratio for Marks and Spencer, and we can see that it's very stable. It's pretty much the same. If you calculate the percentage difference, it would be very small. 1.6%. So this is a negligible change. So we can say that certain things were pretty stable, and those certain things was cost of buying goods, relationship with suppliers, sales price, amount of sales, amount of total cost paid. So these things need to be stable for GP ratio to be stable. How the GP itself is 38% is quite a good gross profit ratio for it. So this means that if a company sells something for 100, their gross profit is 38 pounds. That is quite good. Not excellent. There are some companies doing 50-60% GP ratio, but it is still very good. We will apply the same process to discuss this result further as we have done in ROCE. The next ratio which we are going to do is our net profit ratio. Net profit before tax divided by turnover times 100%. Both of these figures are available in the income statement, so we will go to the income statement to look for these figures. Operating profit before tax. So if you look here, we have figure for operating profit. Our profit before tax is the same thing, don't get confused. PBT, it is 66.8 in 2018 and 176.4 in 2017. That is quite a significant drop in the net profit before tax. We have all the figures. We needed this figure and the revenue figure. We already noted down revenue figures, so now we can go to Excel. Net profit ratio, and for that we need the figure of net profit 66.8 times 100% divided by revenues. We have used here above. And for 2017, we have 176.4 times 100%. So we have got the figures. Now we can solve it. 66.8 divided by revenues. Get 62, and let's do this one, and then I'll solve that out. 176.4 divided by revenues figure, and we got this crazy looking figure. We can sort this out by pressing the percentage sign. 2%. We need decimal places, and I'll do the same thing with this too. So net profit ratio. it has decreased. If you look at the percentage change, okay, so let's copy the formula. Let's see, and that is a massive drop in the net profit ratio. It's a 62.4% drop. So that is quite significant, and the performance obviously has deteriorated quite significantly in this area. Why? Well, if you look at individual numbers, sales are pretty stable, but the figure for profit before tax has decreased. So what you would need is to look at the income statement and see that what is the reason for this massive drop in the profit before tax. And if you look at the income statement, so you can see that the operating profit was 253.2 million in 17 and is almost 60% down in 18. So the main reason was a decrease in operating profit, and that is possible when operating expenses increase. So maybe you need to go into note 2, 3, and 5. So if you go to note 2, 3, and 5, we can actually understand a bit more about the drop. And we can see that the operating expenses have three, four, 6, 0, 34, 63 other operating income. So incomes have decreased. Adjusting items. So the main reason was adjusting items have quite increased, and then the notes. So what you need to do is read more into this, and the annual reports would explain why this was, and so that's what you need to do, basically explain the reason for this increase in operating cost. Quality of profits. This ratio uses two figures. One is from statement of cash flow, which we haven't used so far, so we'll look into that. And the second figure is operating profit, which we have used already. So we need to locate only one figure, and then we can calculate this. And the figure which we are looking for is net cash inflow from operating activities. Slightly different wordings, but essentially is the net cash from operations or net cash from operating activities. And this is the figure which we need for our ratio. So we got both of the figures. We can go to Excel and calculate the ratio. Cash flows from operations or operating activities, same thing, and operating profit. Operating profit we have used before, 156 and 5 and 253.2, and this figure is new, which is net cash flow 849.8 and 1067.7. These are the two figures which we needed. We can do the math. There's no 100% now, okay? This ratio is normally said in times. So what is their cash flow in comparison to their operating profit? And in simple terms, this would be 5 times. So if they're making a profit of 100, their cash is 500. Why is this important? I have explained this in our earlier videos, so please refer back to those if you still don't know what this means. In 2017, it was 4.22%. So it has actually increased. If we look at this, take the difference. And it has increased by 29%, which is a good increase. So this is a positive sign. If you look at overall profitability of Marks and Spencer, they're a bit of a mixed message here. First thing is that the ROCE is deteriorating. Two ratios are deteriorating: ROCE and the net profit ratio are deteriorating quite significantly too. Not just small decrease, but quite a significant decrease. However, a gross profit ratio is still stable, and the quality of profit ratio has increased, which is quite, well, to be honest, for a retailer, quality of profit is not a significant ratio. So I would ignore, when I am assessing a retailer's profitability ratio, I would ignore this ratio. However, the other three ratios are significant, and they're not showing up. So overall, my opinion is that the profitability of Marks and Spencer has decreased from 2017 to 2018. What are the specific reasons? In my understanding, the increase in operating expenses was one of the significant reasons. I'll let you do more research about your company, so you will get higher marks if you can explain the reasons for this and compare it with another competitor as well. Guys, if you do simple calculations for 2 years for a company, and you should still be able to pass, but your marks will not be more than 50%. To get higher marks, you'll have to do 3 years minimum. You'll have to do competitors figures, and you have to pick some industry figures, and you have to do a really good presentation, which I will deal with in the last class. Okay, so that is all for this class.